Hello students, in this session we will be discussing about depreciation and the provisions of depreciation under session 19 of company final accounts. Part 2, schedule 6 of the Companies Act of 1956 requires that the profit and loss account must disclose the amount provided for depreciation, renewals or diminution in the value of fixed assets. If such provision is not made by means of a depreciation charge, the method adopted for making such provision should be stated. But where no provisions is made for depreciation, the fact no provision has been made must be stated, and the quantum of arrears of depreciation computed in accordance with section 205 subsection 2 of the Act is also to be stated by way of a note. So, the section 205 subsection 2 of the Companies Act states that depreciation should be provided either to the extent specified in section 350 or in respect of each item of depreciation asset for such an amount as is arrived at by dividing 95% of the original cost of the company by specified period in respect of such asset, or on any other basis approved by the central government, which has the effect of writing off by way of depreciation 95% of the original cost of the company of each depreciation asset on the expiry of the specified period, or as regards other depreciable assets for which no rate of depreciation has been laid down by this Act or any rules made thereunder, on such basis as may be approved by the government by any general order published in the official gazette or any special order in any particular case. Depreciation may be provided either on the written down value at the rates specified in Schedule 14 of the Act or on straight line basis. In straight line basis, depreciation may be calculated by dividing 95% of the original cost of the asset by its specified period. It means the number of years at the end of which at least 95% of the original cost of that asset will have been provided by way of depreciation if depreciation were to be calculated in accordance with the provisions of section 350. The amount of depreciation charged on the asset every year is debited to the P&L account, and provisions for depreciation account which is allowed to the accumulated from year to year. So the accounting entry which is required for this will be, when the depreciation is charged on the assets, would be depreciation account debitor to the provision of depreciation account. So when depreciation is taken to the profit and loss account, the journal entry would be profit and loss account debtor to provision for depreciation account. When the net effect of the above two entries will be profit and loss account debtor to provision of for depreciation account. If any asset is sold, discarded, demolished or destroyed, the proportionate amount of depreciation relating to the asset must be transferred from the provision for depreciation account to the asset disposal account. When the excess of the written down value of the asset sold, discarded, demolished or destroyed over the sale proceeds or scrap value is written off. If depreciation appears in the trial balance as a debit balance, it implies that the credit has already been given to provision for depreciation account. If any asset is purchased during the accounting period, depreciation may be provided for the full year, and in such a case, a note may be given to this effect. However, according to accounting principles, depreciation should be provided only for the period the asset was in use. Depreciation relating to past years should be treated as appropriation of profits and not charge against profits. So any charge in the method of providing for depreciation should be disclosed along with the quantum of effect on the profit and loss of the company.